Coming to our philosophy, I think that's the core of any fund. So we run this entire fund with a what we call a relative value philosophy. I think the beginning of any value philosophy starts with valuation. And here, what we look at valuation is that we screen the good quality companies, both within the large, mid, and small, and look out for companies where valuations are below the historical averages. What we do believe is that even a hardcore blue chip company, you can name any company like Infosys, TCS, Sun Pharma, you could look through their valuation over 10 years, it never remains the same. It could be at 30p at one stage, it could be at 15p, it could be at 50p. But what it does is when the valuations are lower, either account of certain macro issues or certain company specific issues, if the company has delivered a very good long term track record, then the probability is very high that if one enters at lower valuation in these quality companies, the chances of making very good returns are very high. That is what we believe in. And every cycle, we look at companies which are trading below their historical averages, either in terms of their own history or markets, and we look at relative value. Second, ROCE greater than cost of capital. Now, for any business, there is a certain cost of capital that is being incurred to fund, which comes from the stakeholders, which is either equity or debt. Unless the company makes an ROCE, the return on capital employed, which is greater than the cost of capital, the long-term existence of the company is question mark, or if they're just barely able to meet the ROCE to cover the cost of debt, then it's highly probable that the equity shareholders won't make any long-term money out of it. So our second focus is to screen and look out for companies which do make ROCE greater than the cost of capital. However, I may add that we would also not be averse to investing in companies which have not delivered in the last 2, 3 years, but our conviction level remains very high that in the future, probably in the next 1 or 2 years, they will definitely achieve this ROCE greater than the cost of capital. Third is, I think we are very business focused. So we look at all companies which have sound businesses. Any business where we believe that the structurally weak, which have an inability to generate longer term ROCE, we typically tend to avoid. It's also very important for a fund manager to clearly jot down what he would not buy or what is his exclusion filter. First and foremost is poor operating cash flow. As we can see, I think if you look at all the bankruptcies which has happened in the last 20 years in India, one common reason has been poor operating cash flow. They have not been able to generate cash flows to service the debt, to run the operations, and a combination of both a poor operating cash flow and a weak ROCE through a cycle. So that is something we would tend to avoid in the portfolio, and that is filtered even at the fund house level. Second, governance levels is a paramount for us. So any company with a weak governance is also a strict no for us. And I may also add that we continuously monitor the governance. So for example, if any of our in investment companies where, in our list universe has a governance issue, we monitor it and we don't hesitate to remove it if we believe that it is against the minority shareholders. We also typically tend to avoid companies with debt service, challenges where the leverage is very high. And also we avoid mature businesses at expensive valuation and companies that could experience a serious decline in the terminal value. Say, for example, a print company where, a digital is taking a significant part of their business. In terms of our investment philosophy, as I said, I think the first and foremost is we look at relative valuation versus the history or peer. We look at a reasonably longer term history of at least 5 to 7 years and see where the valuation stands versus the longer term history and also within the peer group and the market. Now, when it comes to mid and small caps, we do believe that there are opportunities where we could get growth-oriented companies at reasonable valuation. This is probably more specifically in small caps, which are not well covered. So whatever most of the small caps, I would say in our portfolio are growth-oriented, where we believe that market has not discovered the potential of that small cap, and we would be one of the earliest ones to do that. The third is we look at cyclical companies. So this is a mean reversion where we believe that cyclical companies generally tend to trade at lower valuations when the cycle is down. We prefer to get into those companies when the cycle is down, and we prefer to get into companies which have strong, which have the ability to withstand the cycle, which are preferably a lower cost. And what happens is when we get in at the right valuation and at the right part of the cycle, the probability of making money is quite high for these kind of companies. So this is the three strategies that we employ for generating alpha in the fund. So just to sum it up, I think the first and foremost is we evaluate businesses very carefully. Whatever companies we have, that business is very carefully evaluated, and more importantly, on their ability to generate ROCs greater than cost of capital over a life cycle. The most important part in any value oriented strategy is margin of safety. Is, what is the margin of safety which is being there in the stock, which probably we want to buy or we want to add. And that comes by the fact that we typically tend to look at valuations which are cheaper than their history. And specifically in terms of picking mid and small caps, I think we do far, far higher due diligence for cash flow and leverage. So you would find that most of our mid cap and small cap companies are typically high ROCE and high free cash flow generating companies. We follow a combination of a sector selection, a top-down approach. Like if we find that certain sectors are quite, cheap in valuation relative to their history, we don't mind taking a sector call. And as well as applicable for a lot of mid and small caps, we kind of look at a bottom up where we study the companies and then take stakes in them. Lastly, the valuation metrics. I think any judge of a fact that whether the portfolio is run with a value mindset is fact that whether the PE and the ROE of the portfolio would be lower than the values of the benchmark index, and they are significantly lower. PE is lower, but ROE is not very different from the benchmark, which again comes back to the fact that we look out for companies, good quality companies, which are trading at cheaper valuations. The fact that the ROE is not very different from where the benchmark.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.